One of the golden rules of dividend investing is to not chase a high dividend yield. You'll hear people talk about this all the time, and in fact, I discussed it at length in my last video, but that's not to say that you should dismiss high yield stocks altogether, because I do think they have their place in a well-diversified portfolio, and there are some really solid high yielders out there, like the one that I bought more of earlier this week. Now, before I tell you all about it, in case you're new to the channel, my name is Ryne Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks, and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Also, let me know in the comments, what is the highest yielding stock in your portfolio? I'd be curious to hear how you're reeling in that cash flow. Now, getting into it, the stock that I picked up this week is Owl Rock Capital Corporation, ORCC, which is a business development company that acts as a direct lender or investor in middle market businesses that may have a difficult time getting a loan from a regular bank. Now, in general, middle market companies are bigger than small businesses, but smaller than large corporations. They're kind of like the middle child in a sense, and there's a few reasons why they may choose to borrow from business development companies like ORCC. You see, business development companies like Owl Rock specialize in working with these type of companies and can offer access to much needed capital that may be more difficult for these middle market companies to obtain through traditional bank loans. And typically, as it pertains to financing, business development companies can offer a wide range of financing options to really meet these middle market companies where they need to be met. This can include senior secured loans or direct equity investments into the company, and in the case of Owl Rock, 85% of their portfolio is in senior secured loans, with the great majority there being in the first lien position, which is where you want to be. This basically means that if one of their portfolio companies were to default on the loan or declare bankruptcy, Owl Rock has first dibs on the company's assets or collateral to help pay off the outstanding balance on the loan. Furthermore, 98% of their loans are floating rate loans, which can fluctuate with market rates, and this is both a good and a bad thing for Owl Rock. It's good because as interest rates go up like they have been, it's going to increase the interest income that Owl Rock is able to generate. And if we take a look at this chart right here, that dark blue line shows us exactly that. Year over year, their total portfolio yield jumped up from around 8% to 12% and resulted in a slightly higher spread against their interest rate on outstanding debt, which is represented by that light blue line. At the same time, though, the higher interest rates put an additional financial burden on the borrowers, which could increase the risk of them not being able to make their debt payments. Hopefully that makes sense. And with that said, Owl Rock does keep a very well-diversified portfolio that contains 187 different companies, and they have a target allocation of 1 to 3% for all of the positions in their portfolio, so they're really not too overexposed to any one particular holding. Furthermore, they tend to focus on recession-resistant industries like software, insurance, and healthcare, and in the recent earnings call, the CEO, Craig Packer, who may or may not be related to Todd, elaborated on the strategy and how it has attributed to the company's success. He says, "We like recession-resistant sectors. We like businesses that have annuity-like cash flows. We like businesses backed by private equity in a significant way. And our biggest sectors, software, insurance, healthcare, food and beverage, have been our biggest sectors every quarter since we started, and it's served us well, and it's put us in a great spot in a potentially weakened economy to outperform." And I'll tell you what, outperformed they most certainly have. Owl Rock's most recent quarterly earnings brought in a beat on both the top and bottom line, with their total investment income reaching a new record while growing a whopping 43% year over year, and as of late, the share price performance has been on fire. Over here on Seeking Alpha, we can see that in the last month, they are up 2.2%, which puts them at a year-to-date gain of 11.33%, so they're doing really well. And that was just Owl Rock's share price performance. If we look at its total return, which takes dividends into account, compared against the S&P 500, it's actually pretty surprising how well this company is performing. Looking at the total return of these two, year-to-date, Owl Rock is outperforming the S&P by about 4%, which was surprising to see. And if we look at its performance in the last year, so the last 365 days, it's still outperforming the S&P by about 4%. However, if we zoom out across the last 3 years, this is where the S&P does show its outperformance against Owl Rock. But I will say it is holding its own. It's really not trailing the S&P by too much. And now comparing Owl Rock's total return against other popular business development companies like Main Street Capital Corporation and Ares Capital, it is underperforming both of them in the last 3 years by quite a bit, about 30%. But out of the bunch amongst these three, Owl Rock does appear to be the most attractively valued. Comparing the price to book amongst these three, ORCC is the only one trading below its book value with a price to book of 0.85, which is quite a bit lower than what we're seeing with Main Street, 1.44, and also a little bit lower than Ares Capital's 1.01 price to book. It's also worth noting that Owl Rock is currently trading at a discount to their net asset value, which is a pretty crucial metric for business development companies, and in this case indicates that ORCC is priced lower than the underlying value of their assets. As of this most recent quarter, ORCC has a net asset value of $15.15, and with a current share price of $13.18, this means that Owl Rock is trading at about a 13% discount to net asset value, ripe for the picking. Now switching gears and getting into the good stuff, talking about ORCC's dividend, not only is it sitting at about a 10% yield, but a few quarters ago they started paying supplemental dividends on top of their regular dividend, which is a nice cherry on top to an already sweet dividend and actually makes the yield even higher than that 10%. Having said that, it is important to note that Owl Rock and other business development companies as well pay a non-qualified dividend, so it's taxed at the ordinary income rate, which is why many investors prefer to hold this type of company in a Roth IRA. But anyway, moving on, like I said earlier, I picked up some more shares of Owl Rock a couple days ago, and here's my most recent tranche. So as you can see, I was able to add a handful of shares. If we take a look at my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to it in the description of this video. I hope you check it out. But anyway, looking at my position here, this puts me at 115.4 shares at an average cost of $13.49, which is not too far above the current share price, so I'm happy to see that. And that leaves me with a share price return of minus 2.45%, not too bad, so I'm down 40 bucks or so if we're just talking share price. But if we look at it on a total return basis, I'm doing quite well. I'm up 11.2%. And as I've slowly been building up my Owl Rock position over the last year, or over the last year and some change now, it's become a really big portion of my portfolio's annual dividend income. At this point, it's bringing in $152.34 every year, which is only second to Altria Group, who's bringing in close to $200 of annual dividend income. But anyway, this represents about 7.4% of my portfolio's total dividend income, which is no small amount. And I think that's kind of the double-edged sword of investing in these high-yield stocks. It's easy to build up positions in these companies and generate a higher level of cash flow, but at the same time, it's easy to let them become a big percentage of your portfolio's overall income, and you really don't want to be too overexposed to any one particular company, both in terms of how it's weighted in your portfolio and also in terms of how much income it's generating for your portfolio. You just never know what can happen, and even though I like the company, I don't want to be too overexposed to it because, you know, really every investment still has its risks, and ORCC is no exception to that. Nonetheless, I still think ORCC has a lot to offer shareholders and deserves some more recognition, just like the 3 stocks we're talking about in this next video right over here. I don't see a lot of people talking about these stocks, but they've all delivered substantial market-beating returns and offer really solid dividend growth. So click right over here to check them out, and I'll see you in the next one.